Okay, so here we are. My name is Rodrigo, as some of you may know, and I am the president and CEO of Prodigy Network. I am talking to you from New York, here in Wall Street, right out there, that window. And I would like to start by explaining why this call. I think that keeping a constant communication with our community of investors is very important for the business in general, and to understand, crowdfunding and the impact that it can have. So in order to tighten, and strengthen our community, we feel that it is important to have these calls, and we're going to be having them on a per project basis every quarter. So this is the first one, and I would like to essentially tell you a little bit of where we are in Prodigy altogether. So to start, we closed on our first project, which is 46th Street, called AK United Nations. As many of you know, it's a 95 unit building, extended stay building, and we were very successful in buying it in September 2014. We got a loan from Bank of America, and then we got a mezzanine piece from MS, which is a pension fund administrator here in New York, and we got investors from the crowd from 11 countries and the United States as well. And with that in mind, we went ahead, we developed the property, and we finally recapitalized the property with CIBC and institutional investors from different places in the world. And that transaction concluded a couple of weeks ago. And the interesting part is that our investors in that building cashed out returns north of 21% after tax. So that really is something that is making me very proud, because it validates the model of crowdfunding. It is very interesting to see how we went from a hypothesis of providing access to smaller investors to this type of assets that were privy to the very wealthy before, to effectively delivering a track record and delivering proof of concept by completing this project from A to Z. So all of our investors are out, and they have their capital and their returns, which again is something that makes us very, very proud, because it's the first building in the history of New York that is completed from A to Z through crowdfunding. Now, AK Wall Street, which is literally down the street here, is slated to be completed in April, and we are going to start operations in that very same month. And we expect, a very, very great deal of success in that project, as well as there is a pent-up demand for steady cash flows in commercial real estate assets in New York. So we believe that we're going to be able to recapitalize the deal very successfully as well. And we anticipate that our investors that came in, with over $50 million in the project are going to be very happy about concluding that investment as well around the summer, we expect, after opening the operations in April. So that's where we are in AK Wall Street. Then in 17 John, which is another one of our buildings around here in the financial district in Manhattan, we empty the building out to start construction. And there are important changes and progress reports on that project as well that I would like to discuss, in the call for 17 John. But everything is moving forward smoothly. We have a loan from Deutsche Bank, and we have also a preferred equity piece from a pension fund administrator, and everything looks really, really well. Then we move to Prodigy on a corporate level. As I'm sure many of you know, we went ahead and we raised $20 million for a corporate bond to finance the growth of our operation after having this track record, and after completing, a number of projects, not only here in New York, but also in Colombia, where we have 3 projects going on. And after raising over $150 million in 22 countries and 17 different states here in the United States, and over, I would say, $220 million in our projects in Colombia. We felt, that we had to invest in the growth of the business, because now we have track record, now we have less uncertainty as to how regulation would be perceived associated with crowdfunding. And now, after completing these buildings, we feel, that it is the time for us to really take advantage of the power of the crowd. And let's remember that we started the model of crowdfunding in 2007. And the origin of crowdfunding was based on the fact that in the last crisis we had, again in 2007, smaller investors didn't have access to the assets that protected the larger investors before. So what happened was that in that crisis, there was the flight to safety and the flight to quality, where large institutional investors and billionaires poured their capital in 3 asset classes. One was gold, the other one was treasuries, and the other one was commercial real estate in 10 cities in the United States. It was put in the 10 largest cities and more heavily populated cities like New York, because when the rent drops a little bit, but you have a steady cash flow of 6% and the prices drop by 2.5% on the asset, for example, nothing really happens to you. And that's essentially what happened with these buildings. The median drop in prices in commercial real estate in the United States was 10%. So a 2.5% drop really was meaningless, and nobody investing in these assets lost the capital. So when we saw that that asset class was the one that protected the larger investors against the volatility of the stock market, we decided that crowdfunding was about giving access to the smaller investors, thanks to technology like this one, to those assets. And that's the only type of assets we focus on. So having that in mind, we believe, that Assemblage 25, which is the project that you are invested in, is going to pose an incredible opportunity right now, because it's no coincidence that the office market is being disrupted substantially through the so-called co-working spaces and the collaborative workspaces. Everybody has heard about the 4th industrial revolution now, and how technology is changing everything and disrupting the way we work, and disrupting the way we relate, to each other, and disrupting the way we use this technology itself. So the potential that we saw in that market, particularly in New York, where 56 million people come here every year, is huge relative to the office business. And Assemblage 25 was originally conceived as a collaborative workspace and then an extended stay, which is a premise that makes a lot of sense, because 75% of the people that work in collaborative workspaces here in New York are from out of town. They don't live in New York on a full-time basis. So you had to provide them with an opportunity of staying here for extended periods of time, since hotels didn't provide a good solution for them. Essentially, people, when they come for longer periods of time, they want to have the opportunity to have breakfast in their apartment, to eat a sandwich at night, and not be in restaurants all day long. So the key here is the kitchen and the living room that you don't have in a hotel, that is much smaller, and you have essentially the opportunity to experience life in New York as a local. So the premise, as you can tell, sounds really, really good. But now, when we started evaluating and assessing in the past 4 to 5 months the potential and the tremendous growth of the collaborative workspace, we questioned ourselves and we said, what happens if instead of doing collaborative workspace and extended stay, we do only collaborative workspace? What if we take the 45,000 square feet that the building has, which is right next to one of the most successful collaborative workspace in New York, which is Noy House. And we just do it all collaborative workspace, understanding that the premise of having extended stay was a very good premise though. And we run the numbers based on the demand that there is for this type of collaborative workspace. And the surprise was huge because we realized, that the NOI, the net operating income, went from $7 million all the way to $10 million. So for as much as we think, that it would have been a great service to provide to the people working in the assemblage to have an extended stay, I think, that we would be better served as investors and general partners in this deal to maximize our potential returns. So the one thing that I would like to communicate to you is that we have made the decision to switch from collaborative workspace and extended stay just to collaborative workspace for the reason explained. The net operating income by selling memberships goes from $7 million to $10 million. So if you run that NOI through the waterfall, which determines the returns you make, will essentially jack up the returns from that we were expecting for the reps from 10 to 14% in average IRR. It can easily go to 12 to 16% and probably more, but we want to be conservative about those projections. And what I like the most is not only that it maximizes revenue for you as our investor and for us, but that it provides us with a safety cushion just in case that things go sideways, from a global perspective. And here is what I want to say about that. New York is very resilient, as we have said before. In 2007, like we also said before, institutional investors chose commercial real estate in the city to protect themselves from the volatility in the market. They didn't invest in REITs. They didn't invest, in multi-asset funds. And they invest in specific buildings like the ones that we bring to you now. But even so, I think that we need to be very conservative and very cautious with what's going on in the world. And here is my crystal ball, What I think is that the domestic US is somewhat isolated from the problems that we see in the rest of the world right now because we depend on domestic consumption. Even today, there's a jobs report coming out that apparently will validate that the United States is not being that much affected directly by what's going on in the rest of the world. However, we see that the situation out there is getting very, very complicated. There is trouble in the commodities market. There is trouble in the currency market. The dollar has gone up substantially. There is trouble in China, and that brings a lot of volatility to the stock market. So the stocks and bonds have been trading, in extremes in a number of ways. We also see that oil obviously has posed an important threat to emerging economies. And well, again, we believe that the United States is isolated from that turmoil and that we're in a much better shape because we managed to delever our economy substantially since 2007. We still think, that we live in the same world. And we want to take a very conservative approach relative to things. So don't analyze the change that I'm presenting to you today as an opportunity to make a better return, which it is, but analyze it from a different perspective. Analyze it from the basis of $7 million of NOI as opposed to 10. The difference now is to achieve the $7 million, we need to have probably 60% of the occupancy on the memberships that we were supposed to have before. So reaching to the NOI that we were supposed to get in the previous model is going to be much easier now. And that's why I'm saying that it is a much more conservative play. Now, if we are not hit by what's going on in the rest of the world, great, because we see exactly what happened in 2007 after the crisis as well. The larger investors did not only protect themselves against the volatility of the market and protect their capital and the integrity of their investments, but they also managed to make a lot of money in the subsequent years based on appreciation. So if we are right and we see that the economy in the United States deteriorates somehow, I have to tell you that I wouldn't like my money to be in any other asset different than the commercial real estate that we're bringing to you. And if we are wrong about the potential slowdown in the United States, I'll always be happy to admit, that I was overly conservative and in my assessments. So, in a nutshell, that is what we wanted to talk to you about today, presenting you, recapping a little bit, the change from collaborative workspace and extended stay to just collaborative workspace. And again, the reason is because the NOI goes from $7 million to $10 million. Why didn't we consider that before? Because we were working on the premise that providing services of extended stay to the members of the collaborative workspace was a great thing. And it is a great thing. However, I see that the demand for collaborative workspace is more than overwhelmingly what I was anticipating before. There in New York, there are many places turning into collaborative workspace, which will obviously increase the supply as well. But there is 56 million people coming to the city every year. There is more people coming here than what they go to Vegas or to Orlando. And they have, certainly much more money for the reasons we know. You have the headquarters of the United Nations here, and this is, the biggest economy center and capital center in this side of the world. So we anticipate, that with this potential slowdown, that the demand for collaborative workspace will even be greater. So we are really at the intersection of a number of factors that justify our decision. So in a way, it's one of those rare situations where you take the conservative decision and you end up being in better shape relative to the potential upside that there can be. And that makes us really, really happy. Just to wrap up, I would like to share with you that our portfolio already is exceeding the $1 billion. It's incredible that this, has happened and where we are. I am very, very pleased. I have seen, that our business is just starting, because when we stemmed off the crisis in 2007 and we entered into the slow recovery, we were competing against stocks and we were competing against bonds and against apartments in Miami, for example, that the smaller investors, chose to deploy their capital. Now I see, that there's a flight to quality again. And I have seen, how the demand has substantially increased for the projects that we bring. Maybe a combination of the fact that we already have a track record and that we're talking about reality as opposed to theoretical hypotheses. That made sense. It also is, the fact that with this uncertainty and volatility, people are starting to anticipate the potential slowdown, and they want to have, the safety of these underlying assets. So we think that in this new market that we clearly see, and we cannot say, that the market didn't change and that the market will not continue to change. The question is to what degree it will change. I think that the demand for our assets is going to keep growing because it is the most solid alternative and it is the most predictable and the most visible alternative that there can be. Now, if you analyze it from a risk standpoint, what happens with this type of assets, is that, why is it that they were so resilient in 2007? As long as you have a rent that services your debt, nothing will happen to you and you will not lose your business, your building. Now, the question is, what happens if for whatever reason the rent goes below the money that you need to service debt? Obviously, the answer is that you need to have a capital contribution. You need to, as an investor, be willing to put more money to reduce the leverage that you have from the bank so that the interest rate is lower and whatever rent the property is yielding can be covered, by that rent. Now, in New York, the fundamentals are so strong that even the variables that define the occupancy, like the memberships or the disruption of the collaborative workspace, and the disparity between supply and demand for this nascent industry is so much that it would have to go below 34% occupancy for us to not be able to service debt. And that is something that has never been seen here in New York, not in the hospitality industry, much less, in a nascent industry like the collaborative workspace, where you will have a much less supply. So in general terms, and extracting ourselves a little bit from the specific quality of our asset classes, we believe that crowdfunding is supposed to be a very important player in a potential down market. Because what happens in a down market is that you have a lot of opportunities to invest in assets. And the smaller investors have never had the opportunity to invest in distressed assets before. So we're very interested in seeing how the economy unfolds to potentially be buying other type of asset classes as well. But that should potentially come, over a few years, I would say. Probably 2007 and 2008. So in a nutshell, what I was willing to share with you is informally a little bit of my thought process, a little bit of how we see the world playing relative to crowdfunding in real estate. I wanted to make clear that this is essentially the third asset class. You have stocks, bonds, and now you can invest in these assets. You need to understand that these investments are illiquid because they're tied up to the liquidity of the real estate. But that's okay, because you are investing in this type of assets, one, to preserve your capital, to decouple from the volatility of the stock market. And essentially, after doing that, we already won. But in addition to that, if we make a good return on our investment in the subsequent years, that would be the ideal play. And that's why this type of assets are in such a big demand, because they provide you with the safety that you need in the downturn while giving you the potential that nothing else gives you on the upside. And that's why we are so happy to be bringing these opportunities to you. Now, like the old saying goes, if you take care of the real estate will take care of yourself. And essentially taking care of the real estate means having a low basis of leverage with your bank so that you're very comfortable that you can service debt, that you can deliver a return that is healthy, and then bet on the future appreciation of these fantastic assets. And like I said before, there are a number of ways of analyzing investments: hypotheses, theories, and realities. And one questionable reality is that these assets were the ones that provided safety for the large investors in 2007. So if they did that in 2007, I am very comfortable that that's the asset class to go to in the potential impending crisis or not. And again, don't get me for too pessimistic. I'm just playing very conservative, and I see, that that's the responsible approach to take. So I believe that's it. I don't have anything to add. I don't know if I'm missing something. Probably not. I think we're good. And please email me directly if you want to. My email is rnino@prodigynetwork.com. We're here to answer any question you may have or a comment that you may have. And again, like I always say, thank you so much for investing with us in these incredible assets in New York. Bye-bye.